What is a currency war? A currency war is the term the news media uses to describe competitive devaluation. What is competitive devaluation? Competitive devaluation is when countries compete against each other to achieve a relatively low exchange rate for their home currency. Why would a country want a relatively low exchange rate for their home currency? A country might want to make their goods and services cheaper in the global market, and having a relatively low exchange rate for their home currency would be one way of doing that. How could a country lower their exchange rate? A country could lower their exchange rate by devaluing their home currency. How could a country devalue their home currency? A country could devalue their home currency by printing more money. The more money a country prints, the less valuable it tends to be. Is that the only way a country could devalue their home currency? No. Another way a country could devalue their home currency is to buying another country's debt. The more demand there is for another country's currency, the more valuable it tends to be. So if China buys USA debt, then that adds more value to China's currency, while it devalues the currency of the USA. When a country's home currency falls in value, its exports usually increase. Besides increasing a country's exports, does devaluing do any other good? When a country is able to export more goods, it often means increased employment. When you have more people working, it usually means more consumer spending, which helps the country's economy grow. So it's all good when a country devalues their home currency? No, it's not all good. First of all, it doesn't always work. And even if it does work, it might cause inflation in the future. Also, it isn't always good for other countries' currency. If other countries' currency becomes more valuable, then it will be harder for them to export goods and services to the country who has devalued their home currency, because they become more expensive. In order to compete in the global market, other countries might also have to devalue their currency. Having all countries devaluing their currency can't end well. So when a country devalues their home currency, it might not be so good for other countries. Is that correct? Yes. Plus, when a country devalues their home currency, it makes imports very expensive. So it will cost consumers more money to buy imported goods and services. Is that all? No, there's more. Devaluation can cause bubbles all over the world. Just look at the price of gold, silver, and other commodities. Many people invest in these risky commodities because other investments like CDs and money market funds don't pay very much interest. This really hurts the person who is on a fixed income and doesn't want to make risky investments. All this devaluation could lead to inflation. For example, a company that buys high-priced raw cotton to manufacture their goods will eventually pass some of that cost to consumers by raising the prices for their products. Is that all? No, there's more. Right now there are gigantic debt and junk bond bubbles worldwide. Money is going into high-risk investments because of the potential higher rate of return, but it causes bubbles which eventually bust. That's everything negative. Right? No, there's more. If prices for imported goods become too expensive, then consumers will buy less imports, and that isn't good for other countries in the global market. So these other countries will have to fight back by either devaluing their home currency, monetary restrictions, or other trade restrictions, which could lead to currency wars or even trade wars. So what is the solution? The Bernanke, who is the head of the Fed, says not to worry, because all will end well, but of course he said the same thing right before the last real estate bubble, and we all know how that ended. I guess we will just have to rub on a rabbit's foot and hope for the best.